Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Charlie Wessel. Charlie is an entrepreneur based in Charleston, South Carolina, where he established and manages multiple companies since 2016. His passion lies in multifamily, commercial real estate, where he has gained significant expertise. In 2016, he founded Cordell Capital to provide private investment opportunities to individuals who usually don't have access to them. Cordell Capital focuses on conservative underwriting and thorough due diligence to protect and grow investors' wealth. Today, Cordell Capital has over 1,000 doors, has over 37,000 square feet of medical space, and 70 short-term rental properties for a total of $162,900,000 in assets under management. Charlie, welcome to The Wealth Flow.
Thanks, Keith. Good to be here, man.
Yeah, I'm looking forward to this. That's quite a portfolio. And what I like to typically do is really start with your background, where you grew up and what eventually led you to being an entrepreneur and also real estate investing.
Yeah, I grew up in Florence, South Carolina. Kind of bounced back and forth between Florence and Cary, North Carolina. And wound up here in Charleston back in 2005. So everything's better at the beach, man. So we live here. It's a great place to live. But yeah, I've always had kind of an entrepreneurial spirit, really. I mean, my mom she was a kind of a free spirit who she did Amway back in the day. I don't know if you remember even what that is, man, but when I was like a junior in high school, I think she paid me like $20 to read How to Win Friends and Influence People kind of thing, which I probably should go back and read again, really. I mean, it was a really good book back then. I'm sure it hadn't changed much, and my dad worked for the same company for 36 years, running a big division of a company, and he did very well. But he always pushed us to kind of go into business for ourselves. I got 4 brothers, and we're all entrepreneurs. We all own our own businesses. It's been good. We've all been very blessed.
Yeah, that's great. And so what were the businesses that you started all based in real estate, or did you focus in different areas before finding the way to real estate?
No, not at all real estate. It was, we had some rental houses, but I was a general contractor here. I started that business in 2006, grew that up and sold it in 2016, started a roofing company. I mean, we still own a roofing company today. Hired some good people. I have a guy that runs that business for us. It's been really, really good. So yeah, I've always been more in the contracting space.
Okay.
We had rental houses. That was, I was a pain in the behind. So we kind of dumped all those off right around 2016, 17. And I found syndication, the world of syndications. and it was just like kind of off to the races from there. I mean, it is, it's been 2016 to now. It's not really that many years, but it's been a lot. It took us a while to get momentum going.
So prior to that, you were doing pretty much everything on your own, and then and maybe for the audience, I think a lot of our audience knows what a syndication is, but maybe if you don't mind kind of explaining, how that works and what differences you saw by utilizing that versus just doing everything yourself.
Yeah, I tell you, I mean, bigger real estate deals it's a team sport. So you got a team that you get together. I'm kind of, when I started, I was more on the acquisition side, looking for properties, doing due diligence, stuff like that. But I found out really quick that, if you don't have that country card club, Fannie Mae and Freddie Mac, it's hard to get a deal. It really is. And not to discourage anybody, because it's done all the time by a lot of people. But
Right.
it's just kind of harder to break into by yourself. So you got to really team up with people. And in the world of syndications, you're teaming up with these people. You have some people that, can raise capital, and then, some people that find deals, and you put it all together and make sure everybody's doing all their general partnership duties to make sure you're following all SEC guidelines, of course. But, you're all coming together, putting this deal together, offering it out to limited partners, which are our investors. And that's how we raise capital, is through, our investor base. And now I'm just on the capital side of it. I mean, we still do our due diligence. We underwrite the deals, but it's a deal that by the time I see it, the insurance and all that stuff and finance, all that stuff's figured out. Like it's ready to go.
And what? So when you first dove into that area, as far as syndicating, what type of property did you focus on?
We were looking at anywhere from 70 to 150 unit apartment complexes.
Okay.
Yeah, and we made it to the best and final and won. I mean, it took us a year and a half of driving all over the Southeast, underwriting deals, putting in LOIs, letter of intents to purchase, and before we finally got one, and it fell apart in due diligence. So we spent $12,000 in due diligence on it, and it just it had polypropylene piping all over the place, even though there was PVC stub outs out in the yards, and it was a 150 unit apartment complex, and we got awarded the deal, but like I said, we pulled out as soon as we found out it was going to be another $450,000 plumbing bill that went into the deal as well. So that's when, I was like, I know people that are doing deals, and these are stand-up people, solid people. I know their families. I know, I've been in this business for a few years now, and I was like, I'm just going to go raise capital. I mean, I play golf here in Charleston. I know some boys with, some pretty deep pockets, so let's go. And it was a lot harder than I thought it was, raising capital. But we've been at it now for several years, and it's picked up steam. And, we have a good little chunk of money into quite a bit of deals.
Okay. And what, so that first one didn't work out, but then you paired up with some people in more apartment complexes after that. Tell us a little bit about maybe some of the ones you were able to take down, and what kind of a raise maybe that you had to have, if you can remember the first couple.
Oh yeah, first deal, I think they were raising, it was like 300 units down in Thomasville, Georgia. About a 16% average annual return. It was a 7-year hold on it. We had to raise it's about $4 million on it. Like I said, I'm part of a bigger group of people. So that was my first raise, and I raised $50,000 from 3 investors.
Huh. Okay.
And
All
that's
right.
when I found out I needed to wear a mouth guard because I just got my teeth kicked in. And I was like so embarrassed. I was like, yeah, I should be able to raise $1 million for this. No big deal. Yeah, I know plenty of people would mind.
Right.
Well, like I said, I got my teeth kicked in, and I was so embarrassed. And I'll never forget what that operator told me. He was like the sponsor of the deal. He was like, "Dude, you just raised 3 times as much as the average American makes in a month in 1 month." I was like, "I guess you're right." Because I told him, I said, "Man, just keep it." I said, I don't need any piece of the deal. Just keep it." And he was like, "Not a chance, man." He said, "Dude, I'm letting you in on the deal." He said, "I know it's your first time, man." And he said, "Dude, you're going to be great at this." And it's gone up from there. I mean, we just needed, I got a deal I've raised $2 million for, and I've got some we've raised, between 500,000 and 850 for. Um, so, I mean, just keep plugging along. It's like anything, man. If you're passionate about it and you just keep digging. And I mean, Lord's blessed us, man. He has. It's been good.
Yeah, for sure. What is there a specific geographic area that you guys are focused in as far as where you're buying? And if so, maybe tell us a little bit about kind of what Cordell Capital looks for, when it comes to potential investment opportunities.
So geographical location, not at all.
Okay.
We're betting on the jockey, not the horse. Horse has
Okay.
got to have good teeth. I'm all about the operators. Most of ours are all vertically integrated. They manage the property management, or they have their own property management company. They do everything. So they're finding the deals. A lot of them are bigger guys that, like Lone Star Capital. I mean, they're like 800, $900 million in assets under management or something. Rob Beardsley and those guys. And some of the other guys that we deal with. I mean, like I said, it's we've had an apartment complex in Des Moines, Iowa. You want to talk about a difficult raise? Talk to the boys on the golf course in Charleston, South Carolina about Des Moines, Iowa. And they're like, "Is that even in this country?" I'm like,
Right.
"Yes, it is. It's actually thriving. It's like a technological center, and it did really well."
Yeah.
But yeah, I mean, like I said, we're always betting on the jockey.
Okay. And you've according to your bio, you've also got medical space as well. Tell me a little bit about that, and when did you start investing in that, and is that still a viable option for you?
Medical office space will always be a viable option because we keep eating McDonald's, and the population's doing nothing but growing here in the U.S. It's getting unhealthier by the second. So there's always going to be a need for doctors. I'll be honest with you, I was talking to somebody about dialysis clinics the other day. I was like, "Let's go. That sounds like a great investment." Sadly enough, I mean, you hate to say it, but it's just back to life. So yeah, we just closed on a 14,000 square foot medical office building last Monday. I mean, it comes out the gate returning like 7.5% cash on cash the first year, and it just goes up from there. And I mean, it's going to be a good hold. We got a good deal on it. The medical office spot we got before that, we're in year and a half, and I think we're just over 8% cash on cash this year. So these are good cash flowing properties. I mean, I'll be honest with you, man. I hadn't done an apartment complex in over just around 2.5 years. I mean, they
Okay.
just, they're good deals. Don't get me wrong. They're safe, good, safe deals. If you get the right kind of jockey, lead it.
Yeah. Yeah.
And he's got the right finance and everything. I mean, there's a lot of different, factors that go into it before a investor just pulls the trigger. They need to know a lot, which is why that's kind of how we get our investors, is because, they know that we're bringing their capital into somebody else's deal, but they know that we have vetted that deal. They know that we know what we're doing now and we know the ins and outs, and, we want to see what the financing looks like. I mean, all kinds of stuff. I mean, we do a complete underwriting on the deals. I mean, it looks good to us. Let's go. And the returns on apartment complexes, yes, they can be really, really good as soon as you sell it, or until you wait till year 5 or something. But I mean, the first few years, you're lucky if you're breaking 6% cash on cash.
Yeah, because you're having to so a lot of these you're reinvesting in. It's their value add type deals. So you've got some capital improvements that are being made, and
Right.
Yeah, it makes sense. Kind of the way that you've got everything set up, it sounds like it works really well because you have the ability. It sounds like you're also in SDRs as well. And so is the guy that you're the jockey that's doing kind of the medical office deal, is that the same person, or do you have multiple people in that space that you
No, it's the same guy. Yeah, it's in Alabama. I mean, he's bird dogging them. And I mean, these things are right by the hospital and great locations. So he's reaching out to building owners. And that's kind of how we got this. I mean, it wasn't even for sale, really.
Okay.
But yeah,
are these single tenant or multi-tenant medical offices?
All multi-tenant.
Okay.
All multi-tenant. Yeah. I mean, I don't even think I'd look at a single tenant anything really.
Yeah. Yeah.
Been there, done that with the houses.
Right. Exactly. They're good until they're not good, until somebody needs to move out.
Nobody lives there. Yeah.
Right. Exactly.
Or the HVAC goes out and you just spent your next 2 years profit fixing, replacing HVAC.
Right. Exactly. So on those, are those going to be, those are going to be triple net though, right? On the office space, or
they're all triple net. Yep.
Okay, perfect. And then on your short-term rentals, you got 70 different short-term rental properties. Was that all part of? Yeah, is this like a portfolio that you've got people investing in, or what does that look like?
It is. Yeah, we have a fund of funds for that.
Mm-hmm.
So we bring our capital into a company called TechVestor, and they're purchasing those short-term rental, properties. They have, like I said, they're vertically integrated. They have their own management companies. They have their own construction crews. I mean, they go in and turn these things into little chunk of paradise with a putting green in the back and a pool and, all kinds of stuff. And they've done really well with it.
And what is there a specific area that they're focused in on for those investments?
There's several different areas. One is in the Poconos. They have a lot in Arizona, around the Phoenix area. They have a lot in Florida. So they are specifically looking, and their thesis behind that was to find places that legislation is in place to protect the short-term rental business plan for the area. Because I mean, here in Charleston County, they've narrowed the gap so small, and they only have a certain amount of permits every year that they put out. Folly Beach here in Charleston, they just eliminated them like almost altogether.
Yeah.
Mount Pleasant here in Charleston, they really put the strings to the short-term rental property owners. So, the legislation, it's got to make sense. And when short-term rentals first came around, that really wasn't, an issue. And like you said, it's not an issue till it is. So it's, we're making sure that the law is set up in these areas to protect that from happening.
Yeah, I think that's wise. It is crazy how a lot of the legislation's changing, and yeah, I mean that can completely destroy what you had in mind if you bought it specifically for that purpose.
Yeah,
Um,
absolutely. I mean,
and
that's
how
how you make your income off of it, you know?
For sure, yeah, and then just to be, and then put you in a position where you all of a sudden have to sell, and hopefully you can sell it for what you were hoping for.
Right.
If the rug gets pulled out, what about how are returns and stuff with the short term rental? What is that? What is that looking like? And how long ago did you start investing in those? Has that changed over maybe the
But
last
it's
couple of
been
years?
it'll be 2 years in December, and
Okay,
they're doing okay. I mean, it should be around, yeah, it's like a 5-year-old, should be around 18% average annual return. So I mean,
okay,
it's
okay.
it's a pretty good deal. We're fixing to come out with a debt validation fund, with some partners in California. I try to stay out of California, man. I try to stay
Right,
out of the left coast as much as possible, but
right.
it's a beautiful area, but government has totally destroyed that, uh, the economics of anything there. But this is a debt validation fund, that's validating consumer debt for. We're really focusing in on our, like veterans, active and retired military, um, our first responders. These guys, they already don't make much money, and these credit card companies that have come in, and, you know basically what we're looking for is any illegal, um, collection practices or whatever. And this group of lawyers yeah, they have to pay a fee to get out of this, to help get out of this debt. But it's, I think it's going to be a good thing. I mean, I probably wouldn't have done it if it didn't have veterans tied to it and first responders. But that's, I mean, to be completely honest with you, it sounds like a Democrat's paradise, doing this whole thing. But I just, there's, I always want to look after our veterans, and they're all young. They don't get paid much money. They get in a bunch of credit card debt, and along with this debt validation fund, we put them through a financial literacy course that
Okay.
they have to finish before helping get them out of this debt. But it's going to pay like 20% APR, and we pay it out, distributions out quarterly. I mean, it's just a great deal that we've worked out with the firm that's doing it for our
Yeah.
investors and for the people they're helping out, really.
Yeah, no, sounds like a good plan all the way around. That's interesting. So you've got that on the horizon. What are some additional things that maybe you see, as far as Cordell Capital? What do you see in the next 3 to 5 years?
I mean, I see us getting into more and more, you know, um, non-traditional investments. I mean, yeah, there's so many opportunities out there. And like I said, as long as we know the jockeys and we know their work ethic and, their ethics all around, and, can really vet the deal. I mean, we'll always stick with, real estate as our main focus, but I do see us going into several different directions on businesses and stuff like that we can, help out and make some money for our investors on the side. I mean, my investors are always first and foremost top of mind
Yeah, yeah, for sure.
at Cornell Capital until 5 o'clock, and then it's 3 kids and a wife.
Right, right. Exactly. I understand that. And and tell me a little bit about how over the course of since you started, your company, how have you grown your investors, and the list, and who you've been in contact with that, is it a lot of the same repeat people, or are you, really branching out? How is that? How are you growing everything?
No, I'm branching out. I mean, I did a webinar for a bunch of, self-directed IRA people a couple weeks ago. We got several people from that. We still do the social media thing. I'm really, I'm 100% honest with you. A lot of the stuff that's posted on our social media comes from assistants that I have that work for us. So it's, and does that work or not? I'm sure it does. I mean, it's top of mind. It just keeps us top of mind with a lot of people. I still, I run into somebody I hadn't seen in years, and you're like, "Oh, Charlie, I see your posts on Facebook all the time." I'm like, "Yeah, you should check out the deals we have." And so there's that. We send out a monthly emails. We probably send out more than a monthly email. We'll probably send one out every couple of weeks. Unless we have a deal, then, we'll send out one or two a week, when we're raising capital for something. But yeah, we get referrals from other investors that we have. Still, it's just beating the streets, man. It really is. It's beating the streets and getting out and getting your name out there. I mean, that's really what it is.
Yeah, and what about, let's maybe go back to maybe multifamily a little bit. You mentioned, some of the returns, really kind of being on exit, and what have you seen that's changed in multifamily maybe since you initially got in, if anything? Obviously the rates have gone, up, and they're now maybe creeping back down. Pricing along the way of those rates being as low as they were, and just the economy being hot there for a minute. It seemed like, things were selling for record prices and compressed cap rates. And, what have you seen kind of since happen over the last couple of years?
Well, and since they were selling for record, compressed cap rates and had low, interest rates coming in and everything, a lot of people were doing the bridge debt, and that bridge debt caught a lot of people swimming with their pants down when the tide went out.
Yeah, for sure.
Now, luckily, we still did a couple of deals during that time, but I made sure that they were all long-term debt. And I had a lot of buddies that were like, "Dude, we can make, so much more money for our investors with this bridge, these bridge loans, and we refinance it in 2 years and be just fine." And I'm telling you, it hurt a lot of people. It really did. I mean, there was a lot, and believe it or not, all the guys that were doing that, they had the best interest of the investors at heart. You couldn't see what was fixing to happen. So, I mean, they meant well. It just didn't turn out well, which happens in this business. I mean, we've got one property that we haven't made return. We haven't made distributions on since COVID, that we just refinanced. Yeah. That one has been the bane of my existence for years, but it's been, we have investors in that deal that have invested in other deals just because they know, I mean, our communication is there. We're always communicating with our investors and just letting them know what's going on. We did just refinance that property, and it'll turn around. It's going to be doing just fine now. So we took a bad egg and turned it around. Luckily, that's the only bad egg we've had. But I make sure any new investors that I talk to, they know the risks. I mean, listen, I tell them about that deal. Oh my God, that deal has kept me up at night. But the guys like I said, the jockeys of that deal, they have worked nonstop at this deal since we got it. And they had 13 other properties, and we had invested in several other properties that just clipped right along. Did fine all the way through COVID. We made distributions and everything. Just this one deal, it just, there was so many different factors that came into it that, it was just not good. I mean, our tenant base was just terrible.
What was that? So that one was a multifamily. What do you think? What were some of the problems you think with that one that caused it to be such a
Okay, so this
challenge?
particular group that we brought that capital to, they were not vertically integrated. They did not manage their own properties,
Okay,
which isn't a bad thing. That's not
right.
always a bad thing. I mean, there's a lot of people that have third party property management, and a lot of them are good, but we just kind of had one right after the other that were not good, and we closed on it in February, and the country shut down in March. And when it did, all the I mean, it's like 35, 40% Section 8. And I haven't done another Section 8 deal since then, because they all got together and they were like, nope, we're not paying any more rent. And I mean, it hurt us bad. I mean, we had like $3 million in funds to do work to the property that went into paying the mortgage. So, we weren't even able to upgrade a lot of stuff that we wanted to upgrade. I mean, we were using reserves and CapEx money just to pay the mortgage. So it was tough. And the bank, oh God, they were just unrelentless. Which, I mean, it's their money. Kind of the old saying is, if you owe the bank $1,000, it's your problem. If you owe the bank $8 million, it's their problem. So, I mean, we didn't toss it back on them like that, but it was like, hey, look, man, you got to work with us here. I mean, you see what's going on. I mean, we're being very transparent in everything that's happening. And, we've gotten a good, property management company in there for the past couple of years. It's just taking that long to turn around. It really has. It's a hard lift. There's a lot of value add projects out there that, some guys, they just don't realize how hard of a lift that can be. It can be tough and very stressful, and it's a lot of work.
Yeah, for sure it is. Oftentimes it ends up being more than you're expecting. As much as you're doing due diligence and trying to, figure all this out, and then get thrown kind of a curveball with COVID. That's pretty hard to see as well. Where was that one? Where did that one geographically? Where was that one?
Columbia, South Carolina, in my backyard.
Oh wow. Okay.
2 hours from my house.
Okay.
Go Gamecocks. Love Columbia.
Yeah.
Love the Gamecocks. You can have Columbia.
Okay. So you must have been the guy with the boots on the ground that they kept saying, "Hey, Charlie, go check that out. What do we got going on over there?"
I went down there several times. They would go down there enough themselves, but I made it my own. I went down there on my own several times just to see what's going on. I mean, we brought investor capital into that. I can't, I feel very responsible for our investors' capital.
For
I
sure.
really do.
For sure. Yeah. And so now you refinanced, you better positioned on it. Do you think you guys are going to continue to hold that one or hopefully when rates?
Oh, yeah, no, we have to hold it. Yeah, okay. We have to hold it to try to, recoup. We're trying to build the investor capital back up. So after 3 years, one strategy that we did there that may help out a lot of your listeners if they're if they have their own deals going on, is we just teamed up with a nonprofit here in the state of South Carolina that you give them like 1% of 1% of the deal. And now they also have first right of refusal on purchasing the place whenever you try to sell it. And you have to keep rent a certain percentage above median income. That percentage still was way higher than where we anticipate pumping rents to in order to keep it, occupied. So it's really a good deal, and it all but eliminated our tax debt on the property. So instead of paying all this property taxes on the property, which South Carolina is fairly, I mean, it's I'm not talking about New York or somewhere where property tax is crazy, anyways, but it's still a lot of money. I mean, when you're talking about an $8 million property tax is a lot of money. I mean, you're talking several $100,000. So we're taking that money and we pay a very small percentage of that to the nonprofit in order to wipe out the tax burden on that property. So if anybody's having, I'm serious. It's a really good deal. We're doing it again on another property of ours in Greensboro, North Carolina, that's doing fairly well. But we ran the numbers on it, and it's like, okay, we're still going to save $70,000 a year back to back to the property by not paying property taxes, and we have to pay this nonprofit $20,000 a year or something. I mean, it's a really good deal.
Yeah, sounds like it. That's is that a national program or is that specific to?
Well, the one here is specific to South Carolina, but I only know this because some of the guys in Texas did it. They did it with a nonprofit there in Texas as well. So I just kind of researched it a little bit and found some guys here in South Carolina that are doing it. That they do it in the Carolinas.
In the motivation for the nonprofit, I guess there's some kind of obviously tax or some motivation that they're able to help supply affordable housing. I mean, is that kind of the basis of?
Yeah.
Okay.
They're kind of. Yeah, I hate to say capping our rents, but
yeah,
because it's still so far above where our pro forma says we're even trying to get to.
Okay.
So it's a good deal for everybody, really, and they're making money. The nonprofit's making money because we're paying them a percentage of what we would be paying in property taxes.
Okay. Is there like an expiration on how long it's capped? Or I know with like some of those programs, it's like a 10-year or 5-year, or is it indefinite that it's going to have to remain at X?
No. I mean, when we sell it, it can either stay part of it, which, I mean, think about what this does to the appraisal of the property. I mean, that just goes into our NOI that's blown up now because we have all this extra money in there, and I mean, it's like I said, I mean, it creates so much more work to the property for the next buyer that I can't imagine somebody not taking that deal. You know what I'm saying? Nah, we'd rather pay the property taxes.
Right.
But
yeah.
It's, I mean, I really, I don't know. I'm going to start spreading the gospel of this thing to anybody I know that owns apartment complexes, really, because it's a really good deal for everybody involved.
Yeah, it sounds like it. That's neat. And sounds like it was a huge tool that helped you guys kind of get out of the situation.
Yeah, in that property, and the one in Greensboro, it's just boosting our returns.
Right. Yeah.
So I mean, it's turned a good deal into a killer deal.
That's awesome. So you've invested in multifamily, office space, short-term rentals, and you've got this debt validation deal. Is there anything else that you kind of look at and say, you know what, we're not in that yet, but I have an interest in it. That looks like it could be good returns for our investors.
Some debt funds. Debt funds are always a good, they're a pretty solid deal. I mean, the returns aren't huge, but it's pretty safe. I mean, you're taking first position on a lot of things. Um, I mean, I'm here at an office space in Charleston called the Helm, and it's full of other real estate investing people. They do everything from the rehab wallet is downstairs. They
Hmm.
they're a debt fund that lends money to flippers and stuff like that. We have a couple of guys here that flip houses, but they do it on like an unbelievable scale. Like they
Okay.
flip
Okay.
like 200 plus houses a year. It's crazy.
Nice.
And then we got some other people that do some bigger commercial deals here. So we're always open. I mean, I'm looking for things that are going to help out our investors. Really. I mean, I'm not offering crypto stuff or anything like that, but as long as it's tangible asset and stuff, and it's or a company that we can put our finger in, I mean, I'm game.
Yeah. Yeah. Makes sense. Well, Charlie, maybe if you can let folks know how they can find out more about you, if they'd like to invest, if they want to hear about maybe some of the other past deals that you've done, and just kind of y'all's performance so far, all that good stuff.
Yeah, just go to Cordell Capital, Cordell. It's 2 L's capital.com, and you can fill out the form there to get our email list, and we'll send you emails on the deals we have coming out. We should probably send out that debt validation fund here within the next week or two. Like I said, 20% APR paid out quarterly. That's
Yeah,
pretty strong.
absolutely.
And that's like a 3-year deal, where after 3 years, then we return all investor capital back to the investors.
Okay.
So, yeah.
No, sounds good. Sounds really good. And I've got two other questions that I ask every guest. And one would just be, any advice you might give somebody who's just starting out in their investment journey.
Just keep going, man. Keep going. Yeah, learn all you can. Go to conferences. You'll meet a lot of good people at conferences. I've spent a ton of money going to conferences. This year, I'm not going to any. Like 2024, I was like, yeah, I'm staying home. I mean, I have 3 kids. They're very involved in sports. I'm usually going 4 or 5 times a year to conferences for, a week or so. And this year I was like, you know what? I'm going to stay here and just beat trees and try to get as many investors as I can. But just always be learning. Always be learning. So yeah, masterminds are a good idea. I'm serious. A coach is a good idea.
Yeah.
It's a really good idea. So it'll help you out. The whole Ray Kroc theory. He already did it. You don't need to reinvent the wheel. Trust me. I mean, you can make a lot of money following other people's way.
Yeah, for sure. No, I think that's great advice. How about a book recommendation, Charlie? Anything that it doesn't have to be real estate related, but it certainly can be. Just something you've read that's been impactful.
Who Not How. With me owning the roofing company and Cordell Capital and having 3 kids, I haven't missed a single field trip since the kids were in kindergarten. And my boy's 15 now, and I have twin 11-year-old girls. So Who Not How helps me spend more time with them when it matters, when I need to. Because I have people that can take care of stuff. I have people that take care of. We have VAs, virtual assistants. We have guys here in the office. It's I don't need to spend my time doing $20 an hour things. I need to spend my time doing $1,000 an hour.
For sure. No, that's a great book. I love it. No, it's fantastic that you're able to do that with the kids and have this roofing company that somebody else is really assisting you. you might be working on the business, but not in the business, which is nice.
I mean, I check the reports for about an hour every day, every morning, and then I have phone calls with the guys. And that's about it.
Cool. All right. Well, hey, Charlie, this has been awesome, man. I really appreciate you being on the Wealth Flow, and thank you so much.
Thank you, Keith. Take care, buddy.
All right. Cool. All right, man. Yeah, thank you so much. Appreciate it.
Yeah, for sure.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.